Every year, thousands of futures traders wake up to discover their positions have been liquidated overnight. Not because they made a bad trade, not because the market fundamentally turned against them, but because the rules changed while they weren't looking. If you trade commodities, futures, or any leveraged instruments, what I'm about to explain can save you from a financial shock that most traders never see coming until it's too late. During the latest silver market sell-off, traders around the world experienced exactly this scenario. Positions were forcibly closed, prices dropped rapidly, and many traders had no time to react. By the end of this video, you'll understand exactly how this happens, who benefits from it, and how to protect yourself so it doesn't happen to you. Let's start with what actually triggered the move. Because this wasn't about supply, demand, or economic fundamentals. Silver prices fell sharply across major exchanges during the most recent trading session. In Asian markets, silver dropped aggressively within hours. In New York, COMEX silver followed with a similar decline, pushing prices down by several percentage points in a very short period of time. This kind of synchronized move doesn't happen randomly. The catalyst was a sudden increase in margin requirements by the CME group, which operates COMEX. Margin requirements were raised by more than 10% per contract, and traders were required to meet the new levels immediately. Not next week, not after settlement, immediately. If you were holding multiple contracts, that translated into tens of thousands of dollars in additional capital that had to be deposited on very short notice. Traders who couldn't meet those requirements didn't get a warning or a negotiation. Their brokers automatically liquidated their positions at market prices. To understand why this is so dangerous, you need to understand how futures margin actually works. Margin is essentially a performance bond. It allows traders to control large positions with relatively small amounts of capital. One silver futures contract represents 5,000 ounces of silver. At elevated prices, that's hundreds of thousands of dollars in exposure, controlled with a fraction of that amount in margin. That leverage is what makes futures attractive, but it's also what makes traders vulnerable. Because exchanges have the authority to change margin requirements whenever they choose. They don't need trader approval, and they don't need to provide advanced notice. When margins are raised, it creates an instant liquidity crisis. Traders who don't have spare cash are forced to sell. That forced selling pushes prices down. Falling prices trigger stop losses. Stop losses create more selling. And suddenly, what could have been a modest correction turns into a cascade. Now here's the part most traders never think about. This mechanism doesn't affect all participants equally. It disproportionately hurts leveraged retail traders and benefits large institutions with deep capital reserves. Short sellers, in particular, tend to benefit from these events. Shorts are traders who sold futures contracts they don't own, betting that prices will fall. When prices drop due to forced liquidations, short positions suddenly become profitable or far less dangerous. This matters because heading into the sell-off, there was significant options exposure clustered around key strike prices. Publicly available data showed tens of thousands of call option contracts at levels that, if exercised, could have created enormous delivery obligations. Each futures contract represents 5,000 ounces of silver. When you multiply that by tens of thousands of contracts, you're talking about hundreds of millions of ounces of potential exposure. In a market where physical availability is already tight, that's not a small issue. That's a systemic risk. Some analysts believe the timing of the margin increase was not accidental. By cooling the market before prices could remain elevated near those option levels, the exchange may have reduced the probability of a delivery squeeze scenario. Is this proven? No. Exchanges will always say they're managing risk and volatility. But the timing aligns very neatly with where pressure was building. This pattern isn't new. Margin increases during strong bull markets have happened repeatedly throughout history. Silver in 1980, oil in 2008, Bitcoin futures in 2017. The sequence is almost always the same. Prices rise quickly. Leverage builds. Short positions become stressed. Margins are raised. Forced liquidations push prices lower. Weak hands are removed. And then, often, prices stabilize and eventually recover. The key takeaway is this. Margin hikes don't change the underlying supply and demand of a commodity. They change who gets to stay in the trade. Another important signal during this event was the price spread between Asian markets and New York. Prior to the sell-off, that spread widened significantly, suggesting stronger physical demand outside the US. As prices fell on COMEX, that spread narrowed, not because physical demand disappeared, but because forced selling brought paper prices down. Whether prices rebound or continue lower from here depends on what happens after the forced liquidation phase ends. If physical demand remains strong and inventories remain tight, prices can recover once the mechanical selling pressure fades. If not, the market may need more time to consolidate. There were also reports that position limits may have been adjusted alongside margin requirements. If accurate, that creates an even more restrictive environment. Even traders with sufficient capital could be forced to reduce exposure simply because they're no longer allowed to hold the same number of contracts. From a trader's perspective, the lesson here is not about silver specifically. It applies to every leveraged market. Futures trading carries not only market risk, but regulatory risk. The risk that the rules will change in a way that directly impacts your position. So what can you do to protect yourself? First, never operate at minimum margin. Maintain a capital buffer well above exchange requirements. This reduces leverage, but it dramatically increases survivability. Second, size positions for worst-case scenarios. Ask yourself if you could survive a sudden margin increase without being forced out. If the answer is no, the position is too large. Third, pay attention to options, open interest, and expiration levels. Large concentrations of contracts at key prices often precede volatility and exchange intervention. Fourth, diversify not just across assets, but across instruments. Relying entirely on highly leveraged futures contracts exposes you to rule change risk that physical holdings or less leveraged instruments don't carry. What happened in silver is not unusual. It's how futures markets actually function beneath the surface. Exchanges protect the system first, institutions second, and leveraged retail traders last. The traders who survive long-term aren't the ones with the best predictions. They're the ones with the best risk management. Because you can be right on direction and still get wiped out if you're over-leveraged when the rules change. Silver will stabilize, prices will find a new equilibrium. But this event should serve as a reminder that preservation of capital always comes before chasing returns. If you understand that, you're already ahead of most participants in the market.
Hello my dear friends, welcome back to my new video and my channel Money Made Simple. Very welcome to my new video. So friend, every year thousands of futures traders wake up to discover their position have been liquidated overnight, not because they made a bad trade, not because the market fidelity turned it against it, but because the rules changed where they weren't looking. If you treat commodities, futures, or any leveraged instruments, what I'm about to explain can save you from a financial shock that most traders never see coming until it is too late. During the latest silver market sell-off, and traders around the world experienced exactly this scenario. Positions were forcibly crossed, prices dropped rapidly, and money traders how to time to rest. Oh, what a good! By the end of this video, you will understand exactly how this happiness, who benefits from it, and how to protest yourself so it doesn't happen to you. Let's start with what actually triggered the move, because this video wasn't about supply, demand, or economic fundamentals. Silver prices feels sharply across major exchange during the most recent trading session. So friend, this is my video. Thank you so much.